Hi, this is Ashish Shanker and I'm happy to take you through the key highlights of 2017 and a peek into what we think might happen in 2018. 2017 started on a very low note as the effects of demonetization were still plaguing our country and economic activity was expected to be slow throughout the year. However, the UP election results in March really perked up sentiment and equities started climbing the wall of worry. And what a year it was for equities. As we finished the year, equity markets, the Nifty did more than 20% plus returns. The mid-cap indices were sizzling, did more than 30%, and the small-cap indices did more than 40%. And nobody would have expected that it would have been such a great year for equities at the beginning of the year, so much so for predictions. The fixed income investors were a little disappointed because there were expectations at the beginning of the year that there would be a rate cut. However, what really happened was commodity prices globally picked up and crude oil prices seeped into inflation in India as well. We saw inflation perking up in India towards the second half of the year and crossed the 4% mark. So we really think RBI missed an opportunity to cut rates this year. Going forward, with a hawkish Fed, it's going to be increasingly difficult for RBI to cut rates. In fact, there is a slight possibility they might hike rates towards the second half of 2018. So we had in fact messaged last year that investors should keep their maturities in fixed income portfolios extremely low, less than 3 years possibly, and just focus on accrual funds and keep it simple. People who would have done that would have fared pretty well. We think the similar strategy into 2018 will also work out quite well. The other big event in 2017 was the rollout of GST. This caused a lot of problems across industries as we saw large-scale destocking and restocking happening. However, it's all behind us and the messaging from many companies, especially in the consumer space, is very positive now, and they believe that business is going to pick up and consumption will also rise going forward, especially in rural areas. We saw the upgrade happening for India from Moody's, which was a welcome good news towards the end of the year, and I think this will lower the cost of borrowings for most Indian corporates in the medium to longer term. The year also saw a political win for the BJP as they held on to Gujarat, and as we go into 2018, political sentiment also remains quite buoyant and strong. The other big news in 2017 was the passing of the lower corporate taxes in the Senate in the US. Now this will have wide implications for people across the globe as most countries will try and align their corporate tax rates to the US corporate tax rates. So this is an area that one needs to watch very, very carefully. So essentially, what do we expect in 2018? We are seeing that US as well as most of the globe is coming off very, very low rates, anemic growth, and they're also coming off low interest rates. We think that this is likely to reverse in 2018. However, what happens in the initial phase of rate hikes is that it is cheered by markets. Essentially, it happens on the back of better economic growth and corporate earnings recovery. So it is normally cheered by markets. So I don't think even if Fed hikes 75 basis points in 2018 is really going to scuttle equity market investors. In fact, it will be viewed as a positive as growth returns to most of the major economies in the globe. India is also coming off a similar scenario where we had anemic GDP growth in 2017 on the back of two big events. We saw low interest rates on the back of very, very low inflation. We believe that is likely to reverse in India this year. So growth will pick up. Inflation is already picked up. So there could be a possible interest rate hike in the second half of 2018. What it will also do is it will also see a pickup in corporate earnings recovery, which should augur well for equity investors. However, challenge in India is valuations. We are above average in terms of valuations across categories. So the first phase of corporate earnings recovery may not see a PE expansion and may not result in very, very high returns for equity investors. But eventually when the investors start believing that this corporate earnings recovery is sustainable, we will start seeing equity markets doing well. So we believe a good strategy for equity investors is to stagger their monies into 2018. More importantly, if you have a longer term asset allocation strategy or plan in place, please stick to it. Just because equity markets have done extraordinarily well in the last 3 years and the past returns are looking so high, there's no reason to change your asset allocation plan. In fact, it is a time to revisit your asset allocation plan and see if the risk in the portfolio has increased. If it has increased, then you probably need to reduce it. So So if you stick to your asset allocation plan, keep the maturities in fixed income extremely low, I think you'll sail through 2018, as I believe 2018 will be a slightly more volatile year than 2017, and it won't be an easy ride as 2017. For real estate investors, there are pockets of good news. There is buying picking up from investors who want to buy for their own consumption. Affordable housing will be a big space. We also think it will occupy a large space of the budget, which is likely to be presented in February. So we are quite excited about affordable housing, and real estate investors who want to buy houses for their own needs. I think it's a good time for them to start looking and making their decisions, as interest rates are low and EMIs have also come off. Gold will be tepid in 2018, but I continue to believe that it's a good asset class to be in, to protect from global risks. So that's broadly what we wanted to message from a 2018 perspective from an investment point of view. I wish you and your loved ones a fantastic 2018 and a prosperous 2018 at that. Thank you very much.